Oh man, to a big day in the markets. We've finally seen some green a full week after Jerome Powell's hawkish appearance at the Jackson Hole meeting. Why? What have we seen today? We've just had a shock jobs report. So we're going to go into what happened in the jobs report. Why is the market moving green? And is this all but a trap? And I'm leaning towards the side that it is a trap. So make sure you stay tuned because I'm going to show you what not to get caught out with. This morning, I made a video explaining that we're in this symmetrical triangle pattern and the bias is towards the downside. And I mentioned if we get some good news, we could get the break to the upside and kind of run towards our EMA ribbon, which I'll show you shortly. But then also, if we have a poor jobs report, we could be falling quickly to the downside. And I said, I'm going to be all in, ready to take advantage of any falls any lower from this region. As you guys know, I have been dollar cost averaging in. I have been nibbling, but those nibbles, for me, we'll be getting more and more aggressive as we fall lower. And if we fall to the bottom of this channel at 18,600, it will be lower. If we start heading towards the price target from this bear pennant, which falls down to testing the previous lows at 17,600, those purchases will get even bigger. Now, on the positive news, which let's take a look, and I'm going to show you what impact it's had on the chart, but let's take a look here. We had positive non-farm payrolls. In other words, it came in today at around 315 versus 526 the previous month. That's that big candle the previous month. We've had a good drop-off in the number of new jobs added, okay? The consensus was around 300,000, so we're at estimate. We weren't too high, we weren't too low. Remember with job figures, this is like the Goldilocks number. It's very important to understand that you want a just right number, and I think the market got that today, which is one of the reasons we're getting a rally on the markets. But I'm going to explain what is causing a little bit of a pump and whether I think it's going to last. And you're going to want to make sure you stay tuned for that, guys. Don't forget to smash the like button. Don't forget to subscribe as always. If you want to buy any of these cryptos like I'm buying, I do so using BYBIT and BitGET. You guys can check those platforms out. They're offering great bonuses in the description and it supports the channel. Now, what I want to look at is this. So this number came out just perfect, okay? If this came out any lower, then you get worried that Jerome Powell driving us into a recession, right? Oh my God, what's he doing to the labor market? He's absolutely killing it. If it comes in too high, oh my God, we're still creating too much jobs. The labor market's too hot. Inflation's going to be high. So it came in at expectations and the market is happy with that. Now to the key bit. Look at this. This is the Fed rate monitor tool. This shows you how much of an interest rate hike is being priced in, because ultimately that's the reason we pay attention to the job figures, to the non-farm payrolls, because Jerome Powell uses that to decide at his next meeting. And the next meeting is on the 21st of September, 19 days away. We also, 8 days before that, on the 13th or so, we get our next CPI reading. So using the non-farm payrolls plus the CPI reading, Jerome Powell will make his decisions of whether to increase rates by 75 basis points again or whether to slow down the pace of his rate hikes at 50 basis points. If we see 50 basis points, the market will rally. If we see 75 basis points, the market won't like that. Now, when we've been monitoring this number, we've seen that 72% of the market over the last week during the pain, during the redness, had priced in a 75 basis point rate hike. That's a top bar there. But now, since the non-farm payrolls came out earlier today, look how it's starting to change. It's now fallen to 55%. That's why we're getting that rally. In other words, some of the market has decided that we now think Jerome Powell will only do 50 basis point hike because it's already taken effect and he won't want to break the labor market too badly. If he's too aggressive with another 75 basis points, he could propel us into a deeper recession, really damage the jobs market. Therefore, maybe he's just going to do 50 basis points. Okay, that is why we're seeing some green in the market. That's why we're seeing the major US indices in the slight green today. But you are seeing that rotate as we speak now. And this is what my warning is right now. And I think they've beat me to it here in the market. But you're seeing this softening. We're now falling slightly into the red here. And I want to take a look at that in the chart. Let's go do that. Let's go into the watch list. Let's pull up what I've got set up here as my green list with my equities. And I want to pull up the S&P and look at this. See this rotation? You've had your run up and now we're starting to see the redness come in here on the hourly chart. Look at that. The last two hourly candles exactly as I expected. And in fact, if we zoom out to the 4 hourly, I guarantee there'll be no surprise at the 4 hourly EMA. There you go, guys. There's no surprise that the 4 hourly EMA ribbon is actually against the resistance, because that's exactly what I shared this morning on the Bitcoin chart, right? You're going to run into your EMA ribbon, which is just a bit of a relief, before then respecting the greater trend, which if I show you here on Bitcoin, continues to be that 4 hourly EMA ribbon. So you can see we got this fake out, pushing, a lot of people jumping into eager longs, right? But I continue to maintain that there's no substance behind this. When the jobs figure meets expectations, I don't think the market can rationally justify the fact that there's not going to be anything other than a 75 basis point hike. I don't think the number today justified that. I know that they're running away and trying to assume that, but when they sit down and think about it, it wasn't a crazy beat. It just meet expectations. If it was 200,000 jobs or 150,000 jobs, by all means, go on your rally and you can understand that Jerome Powell is in control of this and maybe he can do 50 basis points. But with the reading we had, right at expectations pretty much, how could they justify that he's going to suddenly stop doing 75 basis points? So we're starting to see that softening in the market. And what that now means for me is that's what we mentioned in the morning, right? We're going to get this run into our EMA ribbon. This is no surprise, right? If we zoom out, let's just get zoomed out here a little bit. What did we do previously, right? I mentioned this. We ran into our EMA ribbon. We got sent back down. We ran into our EMA ribbon. What's the most likely thing, right? If you were a gambling person, if you're a betting person, if you were to trade this move, what's the most likely thing here? Yes, it's a possibility you can have a relief rally. Yes, there is a possibility you can have a big run up to the upside. But if you were to hedge your risk, where do you think this is going? And that's why I'm preparing myself for another extended move to the downside. Come back down, test the bottom of this symmetrical triangle. And if we do break down to the downside, can we first go test that 19,500 level, then around 19,200, and then start working towards the bottom of this big green channel, which sits at 18,600. Those are the levels I'm looking at right now, and I need to be paying attention to. So we're seeing that softening in the equity markets right now, a little bit of excitement post the jobs figure, now coming back to reality. Wait, has anything changed? And I think the focus will now switch to the next couple of weeks when we'll get the next CPI reading, because that's really going to tell us, are we going to get that second month in a row of CPI declining? That could be huge. I think that is something that the market really can hang its hat on to say, you know what? I want to rally on that, because 2 weeks of improving CPI is not a fluke. That's starting to fall in line with what Jerome Powell says he wants to see, which is continued proof and evidence that CPI and inflation is starting to improve. Okay, so that's what we're seeing here on the Bitcoin chart. And if I zoom out here on the daily chart, you can see exactly what I mean here. Look how far extended we are from our EMA ribbon. The bears are in real strong control right now. And even those that are arguing, are we going to get a rally? How far can that rally realistically go? Can it go up to 22,000? Potentially. If that's what you're in for and you're looking for something like that, fine. But again, you understand you're trading against the trend right now. The bears are the ones who are mainly in control here. And I'll be worried about a potential breakdown of the symmetrical triangle to the downside. That's my main focus right now, is will we get that breakdown of this pattern to the downside? Okay, so you can see that symmetrical triangle right there. Are we going to now enter back in here on the hourly chart, maybe bounce around for a little bit, and then it needs to choose a direction? And for it to choose the direction to the upside, it needs some really big positive catalysts, and I just can't see them. I don't think the jobs figure was that huge of a positive catalyst, and once the market realizes that, I reckon it's going to chill out and say, okay, maybe we got too excited there and we just faked out, we're going to pop back in. Okay, now let's also, just for completeness, take a quick look at our Bollinger Band. And here on the hourly, you can see we got rejected on the top of our Bollinger Band, which is bringing us back down. If there is going to be any support to an upwards move, you want to see another higher low. Okay, guys, you want to, if for those of you who are looking out for a move to the upside, you want to see that come in. So you can see this low, you see this low, you want another higher low. It needs to turn around quicker and then go post a higher high. But at the moment, you're not getting that. Okay, you can see this low there. We're not getting that that higher high. If this went and did something like this, then you've got your trend to the upside. But currently, we're not doing that. We're getting rejected by our Bollinger Band, and we expect to kind of come back into this pattern here. If we zoom out to look at the similar thing on the 4-hourly chart, you can see what's happening. We're getting rejected from the top of the Bollinger Band again, and we're testing the middle of the Bollinger Band here. So you want to see, do we come back down towards the bottom of the symmetrical triangle, in which case if we lose it, things can get a little bit nastier to the downside. And that's where I've got my limit orders ready to pick up some quick, cheap Bitcoin if we get to some of those levels. Guys, let me know what you think in the comments below. What do you think of the jobs figures? What do you think of the Bitcoin market right now? And what are you doing, more importantly, in this market? Are you expecting a big move to the upside? Are you expecting loads of sideways action? Or are you expecting lower price points under 20,000 and below? I think that's the key battle we're facing right now, right? The 20,000 mark is that key battle where the bulls and the bears are fighting. And whoever wins this battle is then going to have the next few $1,000s after that. Are we going to move to 21, 22, 23? Are we going to fall back down to 19, 18, and 17? It's all going to depend on this critical balancing beam we're on right now at the 20,000 level, where the bulls and bears have their final stand. Guys, don't forget to smash the like button. Don't forget to subscribe. As always, check out the links in the description to BYBIT and BitGet if you want to trade any of these exciting moves. Guys, don't forget, if you enjoy this type of content, let me know in the comments. Go watch this video here, and I'll see you in the next one.